So you're actually asking me exactly the way I wanted to answer it, is that because I'm assuming that we're in a trading range, and of course I can change my mind if the market shows me that that's not the case, but that's my assumption currently. If I'm assuming that I'm going to be exposed to a flat market, I have to make sure that I don't have anything in a portfolio that can hurt. Last year, you had a blow up, one name blew up, 17 went up, not much damage, right? This year, I don't have that luxury. I'm assuming that, for every dollar I lose, I have to make 1.5 kind of thing to be on the positive side by the end of the year. So that's exactly correct. It's I spend all of my time thinking about what don't I want as opposed to what I do want, right? So I don't want any companies that can have nasty surprises. I don't want any companies that are not going to deliver on the promised quarters. Those are the things that I've been furiously selling, as opposed to thinking, oh my goodness, what should I be buying that's better than what I already own? I'm pretty happy with the stocks I owned, which have been successful and which have made new highs recently.
Right.
The things that I'm focusing on are the names that haven't delivered and might not deliver. So I can give you examples of those if you'd like, but kind of that's. So Stella Jones love Stella Jones. It's been a phenomenal company for me. The stock's been phenomenal. I like the management. But if you recall, at the end of 2016, you had an industry-wide inventory accumulation of rail ties. And that put pressure on pricing. Stock came off. They reported disappointing numbers. And the management's guided that by fourth quarter of 2017, the inventory would have been eliminated and pricing would be going up. In fact, they reported fourth quarter numbers, and the margins were the lowest of the year. So obviously that's not happening. Even though the inventories are shrinking, that's not translating into better pricing. And the new guidance is that by the end of 2018, that they will have better pricing and better margins. That's not the kind of a company I want currently. Even though I love it, I think Stella Jones still would be a great company 5 years from now. It's not the kind of company I want to own in my portfolio right now. Because what if they miss Q1 and Q2 and Q3, and what if they don't make it in Q4? They didn't make Q4 last year.
Right.
How do I know they're going to make Q4 in this year? It's still trading at 20 times or 18 or off 20 this year's number. So it is a company I normally would be accumulating on bad news, but I have not been doing it. So those are the kind of companies that I wouldn't mind owning in a bull market because you got lots of offsets, even though one of your names is not perhaps behaving. But this year I don't want it. So I'm going to wait till they actually start showing me that they can report better margins before I step back. So that's kind of an example of how what's happening this year is different from what I would be doing last year. So I haven't actually added a single new name to the portfolio. All of the stuff I've been doing is sort of weeding out the names that I think can trip up my portfolio. So, but the one thing I'm doing differently in terms of new names perhaps is looking at shorts. And I'm not looking at shorts because I think the market will necessarily collapse. That's not the thinking. The thinking of having shorts is that if you're going to have volatility, if you have a couple of short positions that are working well, your volatility is reduced. So you're giving your investors less of a heart attack. Every time there's a drawdown, hopefully my fund will be down a lot less. And that's kind of how I try to position what I do for investors, right? Like I try not to give them heart attacks. Cisco would be an example of actually a stock I am long, but purely because they were talking about repatriation. They already gave guidance how they're going to spend the money, which is buying back stock, increasing dividends, and maybe making acquisitions. So hopefully net, that gets me a earnings growth that I otherwise wouldn't have had, like last year or
Right.
the year before. Cisco has a fairly flat earnings profile, but with the repatriation of money, I'm looking at earnings actually growing much more robustly. And it's cheap stock. So at 14 times multiple, and I'm going to get earnings growth, dividend growth, and perhaps an acquisition or two, that kind of is an attractive, that's probably the only kind of new position I put on. The rest of it is all pretty much shorting or selling. Last year, shorts did nothing but cause you headaches. Even the ones that worked were really hard work, right? Because the tendency of the market was, even if something got hammered the next day, somebody wanted to come in and buy it because it was cheap. You have US raising rates. Now this morning, even Europe said that they perhaps should be looking at some kind of a tightening. Well, I don't know how long it's going to take them. Europeans take forever to make a decision, but even they talking about it. The only reason UK hasn't tightened is because they're negotiating a Brexit. Otherwise, I think they would have tightened. They would have raised rates. So you're in an environment that is ripe for end of the cycle kind of corrections, right? Like you are ripe for for the market to be topping. The only reason I'm not convinced that that's where we are now is because of the tax changes that in the US, which almost guarantee you double-digit earnings growth for this year, which the market may or may not react to. We will see. But I also, the other thing I would point to is that there's the repatriation of cash repatriation, and that has been talked about a little bit, but not enough perhaps. And that cash, if you kind of listen to the guidance, a lot of it, they said 40% on average is going to be spent on capital projects. Well, that should perhaps lengthen the recovery by another year or two.